here is a supply zone. So it is basically an area just before a large
we have our top of demand down, and we see there is still a very small inefficiency
we would then look to sell.
So what we could expect to see
this is
is,
a high
even though the inefficiency is very small,
because
the market can come in
selling
and retest that level, and
which
will.
shows that this is a
If
level.
we take a look at the origin of this demand zone, we had a demand zone and we had a push up
good
here,
level to sell
which has
from.
broken some structure.
Seen as a
This
good
push up,
premium to sell from.
breaker
So just to
tells us
recap
that
this
the
one
demand
more
zone we're
time
focused
before I
on,
show you an
this
actual
one,
example,
has created
looking
a
for
lot
a
of demand,
bearish
and we've seen a
trend.
lot of
We want to
buying
make
coming
sure
into the market from this level.
notable lower
Now,
lows
if this is
lower
an
highs,
area that
when it
major
does,
buying
we are
has
then
taken
looking
place
for the
previously,
formation of
and it
some
hasn't
equal
filled yet,
highs, some
we can essentially
resistance.
see this very
Once that
simple
resistance
logic.
is taken,
If this
we
is
are
a
looking
discount
to
price that
sell
people are having
using
to
that
buy from
final
in
tip,
mass,
supply
it's
zone.
probably going to be a discount price
Now
that
this
people
can
will
work
be happy
on
to
any
buy
time
from
in
in
mass.
mass.
Don't
Again,
worry if this is
if
a
the
little bit
market gets
confusing
into
now.
it.
You will see it in real market.
So our trade
we just
opportunity
walk.
now
One
could look
final
like
question
this.
you might
Nice
have about
refined
this
example
is how
where
is
you could
this
buy
not
limited
breaking structure?
1 to 2,
As
and
we
that would
said,
be a
when the
very
market
high risk
breaks
reward
through
trade.
the previous
But what
high
we're going
low,
to do
this
is
should be
something
seen
a
as a
bit more
breaking
similar to
structure.
what I would do
So
here.
why are we now
And we're going to look at a more
sell,
confirmation
even though we've had what we could call a breaking
So now that we're down here on the 5 minute,
instead,
ideally what we want to see is the market coming down into
well, the reason
this
for
level,
that is because of how the
retest
market
it,
reacts
and then
to
start
liquidity,
to break
right?
structure
If
to
this
the upside.
wasn't equal highs,
Why do
if
we
this
wait for
wasn't a
this? Well,
resistance,
the reason
and
I wait
this
for
didn't
this
have a
is because it
significant amount of
creates that
liquidity
high
above it,
accuracy.
then
If we
we
think
would
back to
indeed
our
see
high
this
time frame
break
narrative
as a
in
breaking
every step
structure.
we've taken
But
in this
because it's
analysis
equal
journey
highs,
so
because
far,
the resistance
we built
is
a
still
bullish
here, the
bias
stop
on
losses,
the very
price
high
stops,
time
all of
frame.
this stuff is here.
We've then built this bullish bias on this lower time frame. Now we want this very lowest time frame, the execution time frame, to also align with our bullish bias. Okay, so we want to make sure that the 5 minute is bullish in line with every other time frame that is also very bullish. So we wait for the market to come into this level. As we can see, it has done just that. And now the real structural point for this piece of price action would be this high here. So if the market was to close above this level, we could buy, we could have our stops in the range at a safe level, and then we can take this market all the way up to the high. Okay, so let's jump this forward a little bit. Here we see the market's pushed up and created a closure above that previous wick. So we're just going to line that up. There's our closure. Now what we could realistically do would be use the demand zone beneath, just here, to enter a trade, and we can put our stop likely under the swing low with a better risk reward at this point. So we can buy here, we can have our stops under the low, our targets up into the high, and now we're looking at a 4.17% potential trade, right? So this alone, this setup, you could have potentially found something like this without the high time frame analysis. However, the risk you run by doing that is because you don't have much context. You may have seen that the market reversed sharply from here, so your immediate instinct may be to start selling. You may say, okay, with this push down, we've broken multiple points of structure in this move, so if we pull back up, we will look to sell the market lower. The problem with viewing things from such a low time frame perspective there is that when you incorporate the high time frame narrative that we've looked at, it becomes completely obvious that this is the wrong thing to do. And it's the fact that we've done that high time frame analysis, that we have the clarity and understanding around what the market is actually doing. That's what's going to give us the confidence to take this trade, and that's what's allowed us to actually find this great position. So now we're going to look at actually executing this position. And the way that we're going to do it is we are going to open it in 2 sections. The reason we're going to do this is because I want to show you how you can profit maximize using top-down analysis. So my usual risk for a position is going to be 1%. What we're going to do is open 2 trades at 0.5% and leave one of them running. So we are going to use buy limit orders to get into these trades. Okay, that means if the market comes down to that level, we will be tagged into the position. We're going to open the second one as well, which is going to be another 0.5% risk. So now we're risking 1. But what we're going to do is draw one of the take profit levels all the way up to that high time frame narrative target, which is all the way up here. This is a massive risk reward. So realistically, we've got a day trade with a 4% potential return. But we can, if we want to, optionally swing trade this into something that could get a massive return. Now, I know if you are a day trader, you're probably not going to hold trades for that long. But even if it got a little bit further, you're locking in a bigger profit. And because we have that understanding that the market is likely to go higher, why not hold some to maximize the profits that we can make on this move. So now with this said and done, let's just allow this trade to play out and you will see the process coming together. We have the high time frame, which built our initial bias and narrative for this market. And now we're moving into this lower time frame. And as you can see, we've reacted from demand and we've started to push up, and the market very quickly trades through towards that first target. Okay. Now you're going to see the beauty as well. The first trade is now closed and we have realized a profit of 2%, okay, because we had a 4% trade and we've closed half. We have an unrealized profit of another around 2%. But what we can actually do with this one is hold it and move it even further into profit, which actually comes from the fact that we did that high time frame analysis and understood that the market is likely to go higher. And now I've moved over to trading view because that trade cut me off. The backtest ended, but we can see in real time now at the time of recording this that if we'd held this trade past the initial target of around 4%, which would have been the first overall target, if we'd have held a portion of that position out, it would now in real time be trading at 11.5 off, which at 0.5% risk is going to be around 6%. Okay, so you can see that just by having that high time frame narrative, which was to target the 1.71800 level, we actually managed to massively maximize the profits taken on this trade. We took around 2% profit there, and we'd be running a further 6% profit here. So we've turned a 4% trade into an 8% trade overall, just by having that high time frame narrative. And as I said, you may not want to hold trades all the way. Maybe you still want to get out within the day, but even if you did, you could have got out up here, or even up here, and added 1 or 2% to the profits that you'd have made on the move. To quickly recap the process, we are going to begin on the weekly and daily timeframes, and here all we're trying to do is build a narrative. We're going to find high time frame directions, targets, and momentum using the weekly and the daily. When we've done that, we're going to go day by day to the hourly and 30-minute, where we build our trading ranges for the day. So the upper boundary and lower boundary of where our trades are likely to take place this day. Then we build our narratives inside of there to find out the best place for stop loss. We then go to the 15 and 5-minute to kind of refine all of that, find our target, our entry, our stop positioning, and actually execute the positions that we've crafted through this top-down flow. And the weekly daily work should be done on the weekend, whereas the hourly down to the 5-minute should be done day by day. So this way you can get all of the benefit of the high time frame work without having to make it super time consuming, spending every day doing weekly analysis for pretty much no reason. Now the next thing you need to do is go over to the top link in the description and join 7 steps to profitable trades. In here I show you how to build your first very own trading system. So we're going to go through the process of building a strategy and a trading plan that you can use to consistently make money from the markets. What you can do is move everything we've covered today into a personalized system that works for you. So it's 100% free. Sign up using the top link in the description. I highly recommend it. Thousands of people have been through it and have felt nothing but good things. But if you don't want to do that, check out the video that's on the screen. So here now, it's going to be beneficial for you as well. So thanks for watching. See you in that video or in the free. Top-down analysis, an incredible concept where we use the high time frames, the medium time frames, and the low time frames, and we line them all up together to get the highest probability, highest accuracy, and highest reward. There's one big problem that I want to address, and that is that many day traders believe, because they're only going to be in their trades for a few minutes or a few hours, that top-down analysis is not relevant, and they don't need to be looking at those higher time frames. Now, in this video, I want to show you that couldn't be further from the truth. And if you start to focus on the top-down process as a day trader, even if you're trading the 5 or 15-minute time frames, you're going to have better results and better performance in your trading because you'll get higher accuracy positions, less losses, and bigger wins as well. So with that said, let me teach you a top-down analysis process for day trading. Alright, so here we're looking at a chart. This is a 5-minute chart. On this chart, we can see pretty much a fat load of numbers. This market is really telling us anything. And if we were trying to trade this from a low time frame day trading perspective, we're going to have a lot of difficulty finding a position because realistically, the market isn't doing or telling us anything. So instead of just looking at this in higher time frames and analyzing the top down, and for
these where you're trading anything from the 5 to the 15-minute time frame, I still recommend that you start on the daily. So if we go to the daily time here on Euro USD, we immediately get a better idea of what is going on. So the market right now, from this daily perspective, is somewhat downtrending. This downtrend is pushed past this low here. And this low here support equal lows. We've got 1, 2, 3 equal lows, which creates liquidity. Now beneath that, we have an imbalance, an open price range. This entire candle would be classified as an imbalance, but the market did come quite the way through it without quite filling it. So realistically, the imbalance that we have here is the area that we've just drawn, and this demand zone. So that is our imbalance. Now immediately, we picked up on a few different places that we wouldn't have seen from the lower time frame perspective below. We have liquidity, 1, 2, 3 equal lows, expect, and we have a demand zone with an imbalance, and the imbalance is now filled. Demand zone, which is this last candle before the impulse, is now being retested. So now that we have this sweep of liquidity, and now that we've traded into the demand, what does that tell us? Well, that actually tells us that there could be opportunity here for get high. So even though that lower time frame 5 to 15 minute market is just complete mess, we've got an idea immediately just from looking at the daily. If we've seen sweep of liquidity, fill of imbalance, retest of demand, that could lead us into a balance in this market. Now, if we also consider the trending structure, although this phase that we just discussed is indeed bearish, the larger phase of price action here, being from this low onwards, is actually pretty bullish. We have continual higher highs and higher lows, and we've now identified that this bearish trend has actually just been an back inside of the larger liquidity. How do we know that? Because the break that's taken place here is not a break of significant structure. It's actually leading out to look like a sweep of liquidity and a fill of the balance. With that said, we can then anticipate a continuation of further. We are instead focused on shorter-term moves, which means we want to take a trade that's going to be a few hours long, with the opportunity to potentially stretch it out into something larger if the opportunity arises. So we don't need to stay up here on the daily, but we've got a really nice idea of what could happen now. If we then top-down process by going down to the 4-hour time frame, we will get a clear indicator where we can start to target positions. So taking a look at this market from a 4-hour perspective, we see 2 equal lows, 1, 2, just there swept, and we can see the market is now rejecting that lower pricing, which is indicated by we're seeing coming in. Now this doesn't confirm anything yet, but it is a good indication that we could be through with that reversal that we've just discussed. But one of the biggest things the 4-hour will allow us to do is refine our targets. So if we have the idea that the daily might potentially be turning bullish, we can look for refined target opportunities. The first thing we have in mind would be this supply zone just here. This is the supply. It's a very messy one, but basically, because of the imbalance that we've got running here, that price range, we anticipate that generally the market will at least make its movements up towards this point. Okay? So there's a target for us. But above that, we can see we have this swing high. That could also be another potential target, and a huge open imbalance into this area here. So the imbalance, once again, is this open price range. And now we are provided with a few supply zones. So to mark supply, I use the last candle before the impulse, just here. This is the last candle before the impulse down. And we would do the same here, but it's a bit of a mess. So I'm actually going to trade from the top of the wave down. We are ideally using this last candle before the impulse, which should also account for that choppy news-driven movement. So just by looking at the daily and the 4-hour, that little range that we saw is no longer a complete mess. Instead, we have a pretty solid idea extending some of these intra-week positions, so trades that we hold for a few days instead of just a few hours or minutes. These intra-week positions and being able to turn your day trades into intra-week is where a lot of the profit potential is maximized in your trading. I've taken positions before where I've entered with the plan of taking a 1 to 4 and then ended up holding for a 1 to 30 plus. Now, by no means are these common. This is a once every year or once every 2 years scenario, but these things can happen, and this is where they are born from doing top-down analysis. Okay? So now we can go down to the hourly time frame if we want to, and what we can do here is just refine some of these areas. The imbalance that we just drew now leads us up towards this point, so we can remove this as a target and extend that target even further to this point here. If we were to get the sweep, and yes, I know in 4 hours we just saw it did push down lower, we would then be looking for continuation opportunities up towards this point. This would have a trading format, and then we could potentially extend it even further into intra-week positions to tackle some of these larger areas we discussed. So now let's go down to that day trading time frame. I'm going to focus on 15-minute. This is a good day trading time frame. You can go to the 5, you can go to the 1, but your results will be cleaner 15 minutes, because that is where the opportunities are going to be safer, more accurate. The higher the time frame, the more accurate the signals the market gives us. So we've turned an absolute mess that we looked at initially on these lower time frames into a fully fledged, fully viable trading opportunity. We identify these equal lows. We identify the possibility of bounce from this to up, and some targets. Now we can actually start to day trade this. So after Asia's session, we saw the market move down. We've seen the sweep of liquidity under here, and now we can use these lower time frames to actually day trade our way into larger opportunities. So here we've seen the market sweep this week. We've seen many bullish projections come in, bullish projections indicated by this collection of wicks, which show rejected prices. So what we're seeing here is equal low swap, and then we're seeing it back up. So you get big influx of buying intake. Here, the market failing to close anything lower than this level. Okay. So because of this, we know buyers are coming into the market. The 15-minute here, we've also seen this shift in the structure. This is some internal structure on the start of the day trading opportunity and work with this structure. So what we've now seen is weak liquidity in the structure. Again, shift in the internal structure. That is over at this point at the highest, and also some of these smaller points as well. And what we can do from this point is just follow them. I usually do. So for me, that's going to be looking for demand zones to buy from. I like to buy demand and love to buy. I don't really get to markets in any other way. So for me, liquidity, shift in the internal structure, this would be the demand zone that we could look to buy from. So what we have now is no good just the jumpy box, but also opportunity to turn this into a significant trade. Another thing is trade. Let's say we wanted to target this high this week. This is the only target we can identify. The risk reward is actually second. Okay? The risk reward on this position is 2.1. That's not great for me. I want to be taking more than 2.1 on the trade that I take. Generally, I want to take a 2.5 to 3 or more. So this would be a tricky one for me to kind of push myself to get into. Have to look at my plan. So we can do it. But because we've got that higher time frame narrative, we now understand the market could actually come all the way up to this point, which obviously is going to automatically trade. So now we have a 9.7% potential trade on the bar. Potentially get to this and run it all the way up to this larger time. Now, this is where day trading intertwined with the higher time frame trading or the intraday trading. Okay? There is no reason realistically unless you're trading futures to get out of the trade before the day ends. If you have a clear target defined and the market's moving towards that target, you can hold trade longer. You can still use your day trading methodology to get into the position, as we've done here, but you have the opportunity to hold the trades out for larger targets. Okay? So now let's see how this trade goes. As you can see, we come down, we get a tap in, and out of the way. But there's also a secondary opportunity hold here, if you're a bit more conservative, where we have the true breaker structure. The market comes up, falls down, trades into this demand, and then we get way. We can go stops and low as we would. Same target, that's what we do. So let's just jump it back to the initial, just to keep it running through. Now we can see the market is pushing towards these highs, and where this could be the target done for your day trade, this would actually allow you to extend the profits further later into the day. Okay. So let's take a look where the market gets to by the end of the day. The end of the day for me is going to be classified as around 5 p.m. UK time, which is just where we're coming into here. So at 5 p.m. UK time, that's the end of New York session. The lower volume timing starts here. If you wanted to take your trades and all the profits on your trades now, this would be where you'd be taking your profits. Which means instead of just taking the 2-bar position, you could actually extend around a 4% position out of this market just by using those market timings and that top-down analysis process that we've ran through so far. This is where the real beauty of this top-down process comes in. Now, obviously, first of all, the real beauty came in from the fact we turned this messy, unintelligible range into something that we could actually trade. But past that is the profit maximization that is so valuable. Because we know the market is likely to lead up towards these higher areas on the higher time frame, we can use this intraday entry to extend our profits dramatically. So let's say we wanted to be true to the day trading fashion and get out of half of our trade at this level. We'd now be taking 2% profits from this movement up, which is already good, already a nice return. But what we can now do is allow the trade to continue because we are still running 2% in profits as well now that we're at full bar. Because we have that higher time frame narrative, our trades are going to be a bit more confident holding them for the the longer term. So if we hold the trade, we're going to be holding it through the night into the next day, through London session, and then into the next day's New York session, we get a fill of that larger target, which would be 4.5 or 4.7% return on the other half of the trade, turning this initial 2.1 trade into a potential 6.7, something like that. Okay, so we get 2% profit taken here, and around 4.7 or so taken on the full fill of this move. And all you actually had to do here was not close the trade until tomorrow. You can close a bit, make sure you've got your day trading profits in, but because of the top down move, we need to profit maximize and hold trades a little bit longer to let you get to those larger targets. Now, as I said, occasionally, not often, but sometimes, you'll be able to turn a day trade into something massively significant. If we take a look at the first initial target that we looked at in this market, the higher one, and we extend our targets up to this point for the second half of the position, we now turn a very small profit potential trade of 2.1 odd into 25%. And obviously, being a day trader, it's likely that you want to take at least half the profit before the day is over. So you've taken your 2%, that still leaves open an opportunity to make 11.25% here on this continuation through, simply by not clicking the close button. It's really that easy. When you get into a market and you've got a solid narrative, all you have to do is just not close the trade. If you leave the trade running like this one here, within just a matter of days or a week, you can get significantly larger profits from your positions. So this is where you benefit from using those day trading entries to get super rough stop losses, and then using that higher time frame picture to actually nail huge targets. Okay, small stop, large target. It's going to be a significant risk reward, and that will turn this position into a potential trade of around 13.5% or 13.25%. Hard thing again, hard thing again. And let's take a look at how long this trade took to get out. So this is running from the 14th to the 22nd of February, which means this trade was held for 1 week. It's really not a long time to hold a trade that you can get this much profit out. Okay? And now from this point, obviously, with the high time frame narrative, we may have the idea that this is about as far as the market's going to get. So then we can go to the lower time frames from this line and look for shorting opportunities to capitalize from the big. Here's how you can use top-down analysis to get more profits out of your day trades. If you do this, you will turn choppy ranges into very clear ranges to trade from. You've got that bigger picture narrative telling you the context you need to understand where the opportunity is. 5 minutes looks like a mess, 15 minutes looks like a mess. If you go to the daily, you can make a lot more sense in terms of where you can target and where you can get it. And the profit maximization you can get from doing this allows you to catch some of these huge trades that, number one, will be very nice for your account balance, and number two, right about to correct. So that's it for this video. Or head to the link in the description and join my free course. Thank you for watching. I'll see you in the next one. Supply and demand trading is without a doubt the best way to do technical analysis. If you can understand supply and demand, then you'll be able to make some brilliant decisions. So in this video, I'm going to teach you pretty much everything that you need to know about supply and demand to start getting the same results. If you understand the concept of supply and demand, you will have everything you need to carry out profitable technical analysis. I'm going to give you absolutely everything you need to know from my individual experience. So the first thing you need to know is that markets are driven by buying and selling. The whole reason that markets move is because traders are buying and selling assets. More importantly, it's the institutional traders. So in a market, we have two types of participants: institutions like commercial banks, hedge funds, central banks, and retail. But most retail traders only make up a very small percentage of the overall trading volume. So it's the institutional traders that actually move the market. So when these institutional traders are buying, we see the market up, and when they're selling, we see the market down. And this happens because of supply and demand. If there is high demand for an asset, the supply gets built up, and then the prices go up because the people that hold the asset demand for the transaction. So if there's high demand for an asset, markets will move up. If there's low demand for an asset, markets will move down. Now, to explain this in a simple form, let's say I've got no one's interested in buying my technical point. At this point, I'm going to have to sell them pretty cheap, otherwise I won't sell. But let's say suddenly something in the market changes, and now these commodities are in high demand. Well,
to buy the monopoly as fast as possible, which means if I want to, I can have the price, or also pay for it. And every time one of these gold coins gets purchased and is taken to the market, the prices can go up even more because the supply falls. So high demand means low supply, and this equates to high prices. Now imagine someone else comes over for 100 more gold coins. Now they're not so rare, so people might not be so interested in buying. The supply is increased, the demand might fall, therefore prices will fall. That is the basic theory of supply and demand. And this is pretty much exactly what we see in the market. Now, supply and demand zones are plotted on as consolidation areas before large upward or downward movements. And a demand is simply a discounted price to buy from, while a supply is seen as a premium price to sell at. So to explain that quickly, if you bought something for $100 and suddenly it was $150, you might get $100 in the market. So the market gets back down to that discounted $100 mark. The same with the premium price. Imagine the price of that $100 purchase got to $200. Well, that's a premium. You might want to sell that because you've doubled your money. If the market dips, but then comes back to that level, it'll be seen as a premium, so you may want to sell it again. And this is exactly the kind of thing we see in the market and how we aim to trade supply and demand. When a market pulls back to a demand zone, we want to buy, and when the market pulls up to the supply zone, we want to sell. As I've just stated, supply and demand is visualized as zones in trade. Specifically, consolidation areas before large up or down moves. But there's a specific way to get to real time handle before a down move before the supply zone. Now, I have a way to do it, which I find works better for me, and that is to use the last candle before the impulse. So an impulse is a large movement, either up or down. In this instance, obviously, we are seeing the market is bullish and the market is pushing up, so we have this bullish impulse. Now, the last candle before the impulse is always going to be some form of indecision candle with wick on either side, a smaller sideways ranging body. Now, if we consider what this candle is actually showing us, this is where the significant buying has taken place, because this is the final point before the market exploded to the upside. So by using this as our demand zone, we're focusing on the prime area where the mass buying really took place. Now, realistically, you can choose whichever one of these methods you like, backtest them if you want, but this is how I did the last. Now I'm going to show you what it looks like, and we can plot these zones on the charts. So in this example, we have this large bearish also movement, and above that we have this sideways candle, this indecision candle. So an indecision candle is defined as such because it's showing indecision. It's not showing clear control from buyers or from sellers. This candle here has got a large wick above and a large wick below, which means that buyers are tempted to go higher, sellers are tempted to lower, but really it closes a pretty decisive candle. Compare that to this one here, where we have a huge selling push, and there's also no wicks. You can see that clearly the sellers are in control. So this candle here at the top is where institutional selling entered the market, which makes this supply. So we're using that last candle before the impulse. This is the final point of which the sellers took control of the market. This is where those major sell orders will be placed. So the concept now would be, because this was seen as a premium price to sell from in the past, if the market is able to get back up into this zone, we would be likely to see a growth in sellers. If you sold your asset up here at a high price and you had some more, and you wanted to short sell the market, well, if it gets back up from there again, you see this is a premium, you'd be happy to get back in or get back out, depending on sell more contracts in your existing position. So if we play this market forward, you see the market trades up, comes into this area of supply without breaking the high of the zone, and then we have to push to the downside, which leads into a new sell trade opportunity. Now, supply zones are always selling zones. So supply is always consolidation before a large downward, and we always only want to sell from these areas. Demand would be the opposite. Would be a demand zone, and then the focus would be on buying once the market came into the concept of demand. We need to make sure we're always in line with the trend. So let's discuss that. So in this example, we can see the market is trending to the upside. This low, we have a lower high, we have a lower low, and then we shift into a higher highs. Now, because the market has shifted into a higher high, to play a new higher low to form, and a continuation then to new higher highs, as we see in this market. If the market was forming and printing higher highs and higher lows, we must only be buying demand that was pretty much completely ignored any supply zone. We can use supply zones from targets, but we absolutely shouldn't